Morgan Stanley Capital International has changed its weightings for a number of Adani Group stocks. The index provider took this step after reviewing how many shares could be freely traded. MSCI has cut its determined free float for Adani Enterprises, Adani Total Gas, Adani Transmission, and ACC. The cuts will come into effect at the end of February. As a result, passive funds that track the MSCI indices will have to prune their exposure to Adani stocks to realign with the revised composition of the index. The fresh blow comes in the wake of a report by US-based short seller Hindenburg Research that has accused the Adani Group of stock manipulation and improper use of offshore tax havens. The group has denied any wrongdoing. Adani's troubles have cast a shadow on the larger India story too. This is because the group operates some of India's largest ports and busiest airports. It also accounts for a third of the country's grain storage and operates a fifth of its power transmission lines. More importantly, it was expected to play a significant role in the country's ambitious infrastructure plans. But now, there is increasing scrutiny of Adani's finances by banks, and financial institutions are examining their exposure to the group. As a result, access to financing is set to become more challenging. So, the Adani Group may have to go slow on its planned investments, and that could be a problem. The Adani Group accounts for 3% of India's pipeline of major current and planned capital expenditure projects by value, and almost 10% of the newer projects that were announced in FY22. This includes both public and private projects. The Economist arrived at this finding based on CMIE data. Under the National Infrastructure Pipeline, the total capital expenditure in India during fiscals 2020 to 2025 is projected at $1.35 trillion. The private sector's share in NIP implementation will be 21%. The NIP is the centre's medium-term vision of infra development in India and includes central, state, and private sector projects. Last year, the Adani Group had announced at least $110 to $140 billion in investments across infrastructure sectors in the next 5 to 10 years. The investments were earmarked for green hydrogen, green energy, electricity transmission, roads, data centers, and airports. What is the overlap between Adani's planned infra investments and the NIP's headline number? It remains unclear, but Adani's expenditure projections do tell us about its importance in India's infrastructure ambitions. So, how will those ambitions be affected?
The investors in India's infrastructure come across a variety of institutions. They are the central government, state government, urban local bodies, private capital, domestic as well as foreign capital, and entrepreneurs and industrialists of various shades who all contribute to investing in one way or the other into different sectors of Indian infrastructure. So the current issue surrounding the Adani Group, I don't think in any way will impact the big India story and its ability to attract investments from all these different investors. But specifically for the Adani Group, I think that they have publicly stated that they are rejigging their capital raising and capital allocation plans. So I would expect a blip in their capex spend anywhere between 6 months to 12 months. But I would like to believe that after a year, their capital expenditure on the committed projects would be back to normal.
Adani is not India, and India is not Adani. I think the world needs to be clear on that. Yes, being among the largest conglomerates, they have been taking part in the major infra projects, but there is enough and more in the competition to take up the new projects. Nobody has questioned the viability of the group's businesses. The only issue could be the prospects of immediate fundraise. I think that could dim. So I don't see any issues with the existing projects they are handling since financial closure is in place. It could get a bit slow for them in terms of new projects. Some of the bids they have won recently could come under scrutiny. But to say that India's infrastructure growth will slow down due to the Hindenburg Adani episode could be a bit far-fetched, especially when the overall capex planned in the recent union budget is at a record high.
The sentiment on India's infra plans is bullish.
India plans to spend US dollars 1.4 trillion under the Gati Shakti program, which includes major projects such as GMIC, bullet train, Sagarmala projects, smart cities, metro corridors, and new airports. In the Union Budget 2023-24 as well, the government's focus was clearly on infrastructure upgrade, with capital investment outlay increased cheaply for the third year in a row by 33% to INR 10 lakh crore. All in all, with the nation's massive focus on infrastructure projects, the economy at large and the real estate sector in specific is likely to benefit.
If the Adani Group's appetite for ambitious infra projects is reduced in the wake of the present crisis, other players will eventually rise to the occasion and fill the gap, even if it takes them about a year to do so.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.